That shows it. Okay. Go ahead and get started now. It's a couple of minutes after 1, so I wanted to be aware of everybody's time and go ahead and get started and go through the presentation. I want to thank everybody for coming today and wanted to learn about some self-directed IRAs and then some opportunities to use those self-directed IRAs to invest in certain types of investments, and one of them we've got to have a presenter this afternoon from Realty Mogul, and that'd be Jillian. And so what the process is going to be, I'm going to go through probably about 15, 20 slides about self-directed IRA, because there are people here that are clients, but there are also people that are not, that want to learn a little bit about self-directed IRA. Then I'm going to turn it over to Jillian, and she's going to talk about what Realty Mogul does, and then how you can use your self-directed IRA to invest in what she does. So getting started. As you can see, we're talking about reinventing your retirement. Most people are completely unaware of what self-directed IRAs are and how they work and the opportunities that come with it. So that's why we kind of started this way with reinventing your retirement, as most people think that you can only do stocks, bonds, mutual funds, and CDs. What point did it go? There we go. Today's webinar is strictly for informational purposes and educational purposes. IRA Innovations is a third-party administrator of self-directed retirement plans. However, we are not tax attorneys or CPAs or financial advisors or anything like that. We provide education and to let people understand the opportunities that are out there. But if you've got specific questions about your financial condition, whether this is right for you, the different types of accounts you may be looking at opening, we would strongly suggest that you consult with your trusted advisors, your attorneys, your tax professionals, your CPAs, your financial planners. So again, we would like, this is an educational purposes, but if you've got specific questions on that, those are the people you ought to address. And let me address questions right now too. Right now I've got everybody unmuted, so if we can keep it this way and we don't get really any background noises, I'm going to leave it that way. And please just pop in whenever you get a chance if you've got any questions on any of the screens that, or any of the information that we're talking about. This specifically is going to talk about real estate in a retirement plan, but there are other things that you can do that we'll get into that in just a minute. Few people are aware of what the IRS allows you to do. Most people think that you are strictly limited to stocks, bonds, mutual funds, and CDs as investments in retirement accounts. This is, this is furthest from the truth. The opportunities to invest in what in the industry are called alternative assets have been around since the IRA code the IRA section was written in the IRS code. This was not anything new that has been done since then, but this was from the beginning when IRA started. It's just that out of the gate, the brokerage companies pretty much went after that group because they already had people that were investing with them, and they said, now you can just put the things that you invest in outside your IRA into your IRA. And that's kind of what we're telling people too, is that if you are good or understand the real estate market, IRA investment is good for you. If you understand the private equity market, that's another opportunity you can do. If you understand factoring, the buying of invoices or accounts receivable, that's another thing you can do in here. So we're pretty much on the same line in that what you can do and what you're comfortable with outside your IRA are good investments that you can do within your IRA. And this, I guess, talks about what you're talking about. You make your own investment. You know what you understand. The best thing about IRAs is that they may be, that they either are tax deferred or tax free. Tax deferred meaning that you can invest, you can contribute to your IRA. Any gains that are done or made in your IRA are tax deferred. You don't pay taxes on it at the time that the wealth is accumulated. You take that money, and then when you distribute it to yourself at certain points in your life, that's when the tax event takes place. So you get to use, for the most part, there are some limitations, but for the most part, you get to use all the money that you invest in and that you make and as profits back into your next investment. So that's an advantage of using it within your IRA as a tax-deferred option. At some point, usually at 70 and a half, you have to start taking some of this money out. It is at that point considered ordinary income and is added to W-2 income, 1099 income, and at that point, you're taxed on it. Now, there's one other option that IRAs have, which I really think is great, is that the Roth IRA. The Roth IRA was created about 5-7 years after all the other IRAs were created. In that, you are able to contribute using after-tax money. So instead of getting a write-off on your income taxes for your contributions to your Roth, it is after-tax money. However, with the Roth, any gains that are made are never taxable. So all those gains are tax-free. Again, you can start taking them out usually at 59 and a half, and the IRA, but it would have to have been open for 5 years. But everything comes out tax-free, and there is no requirement to take money out at 70 and a half. So those are two estate planning tools that you may want to look at when deciding which ones to open and how you may want to invest. And also you can have also a traditional and a Roth. However, you can only contribute the maximum, for example, the maximum this year is $5,500 for each of those, so you can contribute, let's say, $3,000 to the traditional, leaving $2,500 to do to the Roth. So there is a maximum that you can do, or you can put all of it in one or the other. The last two on this slide, the Coverdell Educational Savings Account and the Health Savings Accounts, are not really considered IRAs, individual retirement accounts. However, they can be used in the same way in that you can invest in alternative assets through these opportunities the same way that you can with your IRA. The Coverdell Educational IRA obviously is used for education, whether it's primary, secondary, or college education, and then the health savings accounts are used to pay health expenses, but they don't have to be done in the year that they are incurred. You can actually build up a nest egg of health savings account and then come back and pay those health bills out of their, pay you back actually for paying them. So what does the IRS say about these types of investments and what you can and can't do? The IRS, let's see if it's on the next page. Yeah. Here's a list of the things, just some of the things that are possible. The IRS does not actually say what you can or what you cannot invest in. I'm sorry. The IRS doesn't say what you can invest in. It says what you cannot invest in. And it's very specific. So if you actually look at the code, it'll tell you that you cannot invest in collectibles, and then it starts to define collectibles as stamps, coins, rugs, artwork, antique cars. So those are things that the IRA cannot invest in. Additionally, somebody's back there. Additionally, you cannot invest in gold or silver coins other than American Eagles. American Eagles are the only things that you can invest in within an IRA, either gold, silver, or platinum American Eagles. Any type of bullion is allowed in the IRA. And then finally, you cannot invest in life insurance in your IRA. Your IRA cannot buy life insurance and then use that in the IRA. And then finally, you cannot buy wines or liquor. So those are the only things that you cannot invest in, leaving this list and other things that you may want to look at. So you can invest in real estate. You can invest in mortgage notes. You can invest in tax lien certificates. You can invest in publicly and non-publicly traded equities, commercial paper, such as car paper or such in factoring, that type of stuff. All those things are allowed, and anything that was not what I didn't speak about. And again, here are the things that you cannot invest in. And now there are certain people that you cannot do business with. These are called disqualified people. Now, disqualified people are you and your spouse, parents, grandparents, children, grandchildren, and their spouses. So it's lineal ascendants and descendants. Okay? So that would mean that because you're talking about lineal ascendants and descendants, sideways, when you talk about brothers and sisters or cousins or aunts and uncles, they are not disqualified people. They are people that you can work with. So, so a lot of people ask, well, can I, a great thing is, you know, I've got a child going to college. Can I buy a condo there, and can they, quote, rent it from me while they're at college? And the answer is no, because they are a disqualified person. They are a lineal descendant. However, a niece or a nephew could do that because they are not considered a disqualified person. Additionally, any fiduciary of the IRA, so in this case that would be me, I could not work with people that have their IRAs with me. Anybody providing services to your IRA, again, that would be what we do, but then also it could be providing services to your IRA could be your financial advisor. So they would be a prohibited person because they are providing financial advice to you for your IRAs. Any legal entity in which disqualified people own 50% or more of that entity is a disqualified entity. So your IRA is a legal entity and can partner with and work with any other legal entity, including corporations, trusts, LLCs, those type of entities. However, if those entities' ownership is owned 50% or more of disqualified people, then that entity is considered disqualified because of the ownership rules. Now that specifically is in the code, the 50% rule. Recently, in the last, I guess, 3 or 4 years, there was a tax court case where there was a man who lent money to a corporation of which he owned 20% of. And he lent the company money at market interest rates, you know, the payment schedule, everything was in order. However, the IRS took him to tax court, and the tax court ruled against him. And the reason is because he was the CFO, and they said that he had undue influence over the affairs of the corporation. And so while he and any disqualified people did not own at least 50%, the IRS came in with basically a new rule that says, well, you can't own less than 50%, but you also cannot have undue influence over the affairs of the corporation, which is the last one. And then, since you've got disqualified people, if there is a transaction between a disqualified people and an IRA, it is considered a prohibited transaction. And so that's what we're talking about here. You can't, if you own something, you can't sell it to the IRA can't sell it to you. You can't use the assets that are in the IRA. The overall, if you look at the code and you look at what the overall intent is, that these investments, these funds are for retirement. So the IRS looks at it as if you are benefiting today from assets within your retirement account, then that would be considered a prohibited transaction. Again, that example of using that condo and a child going away to school, buying the condo, the use of that condo would be the prohibited transaction. What makes it a prohibited transaction is that it's the disqualified person, the daughter, is using the condo. Here's just some examples of prohibited transactions. There are more, but you get the idea from what these are as to what is prohibited and what's not, and the kind of things that you need to stay away from. I get questions all the time about, well, well, can I do this that's just, real close to the prohibited transaction line? And what I say is there are so many things that you can do that the IRS allows you to do. There really is no reason to, I would say, tempt them in the type of things that you're looking to do, because there are so many opportunities out there in what you can do. Why even look at possibly voiding your IRA because of prohibited transaction? And that kind of is what happens. If there is a prohibited transaction, the IRS determines that you have done a prohibited transaction, the asset is considered distributed in the year the prohibited transaction took place. So that means, let's say it's 2013 now, and I had a prohibited transaction from 2005. At that point, the IRS would say that I had a distribution in 2005. It was a non-recorded distribution at the time, so I have additional tax because I had that distribution, and I have penalties and possibly fees because I did not include that in my tax return for the last 8 years, from 2005 to 2013. So it is possible, and it has happened, that prohibited transaction charges have cost the IRA holder the whole value of their account. So it's best just to know what they are and to kind of stay away from it. Again, here's some things that you can do with disqualified people that are allowed. For example, partnering with yourself and your IRA on a new deal. That's the caveat there. You're not going in there and buying it or something that already exists between the two of you, and you're buying more of it or distributing it. Partnering with your cousin. Obviously, your cousin is not a disqualified person. Partnering with your spouse on a new deal, because it is a arm's length transaction, and not just with your spouse, but your spouse's IRA. So you could have an IRA and your spouse can have an IRA, and at the time of purchase of a real estate piece of property, the two of them can come together and own a percentage of it. The percentages are based on how much each of the IRAs brings to the table. So it could be 60-40, it could be an even split 50-50, 90-10, whatever the IRA brings to the table in terms of the cost of the asset is the amount that they own. You can't come in there on a $100,000 asset and bring in $10,000 and expect to get a 50% share of it. At that point, obviously, you would get a 10% share. So here's just kind of a review. Your IRA purchase real estate, is that allowable? Yes, as long as, again, it's not something that you already own or any disqualified person does. You live in the IRA and the real estate purchased by your IRA? No, you are a disqualified person and you are benefiting from that asset today. You personally collect rent for your IRA. That could be, and here we've got it very conservative, is a no, because you are performing services without compensation, and so the IRS could potentially say that it is a non-cash contribution. So it's a very good idea to have a property manager do that for you. And now, like I said, this was to go into case studies, but because we have somebody here today that has an opportunity, which I think is a good opportunity, I can just give you some background. Where we met Jillian. We were at a crowdfunding conference probably about 6 weeks ago in Orlando, and ran into Jillian and Realty Mogul, and we talked and saw that this would be a good fit for both IRA, self-directed IRA clients, and the things that she's offering. So we decided that we'd put together this webinar and kind of go over what the self-directed IRA is, and then have her spend some time as to what she does and how it fits into the self-directed IRA. So at this point, I'm going to turn this over to her. Oh, let me turn this over to her first. Let me find her.
Can you get them to see Mom's phone?
Mom's phone?
Let's see.
No, I haven't.
I'm going to mute everybody first. There. All right, Jillian, you've got the controls. It's up there in the left-hand corner if you want to go ahead and do that. Actually, I'll do it. There you go. It's all yours. Oh, sorry. I got to unmute you. There. Jillian, you there?
Great. I'm here. Can you hear me?
I can now, yes.
Fantastic. Well, thanks so much for having me on today. I really appreciate it. Bill, there we go. Okay, let me just make sure that I can control these here.
And then you go on the right-hand side is for the next slide. That arrow.
Got it.
Yep.
See if I can get it to go.
It is. It's going. It might just be slow on yours there. It's already gone through 5.
All right. Well, thanks so much for having me on the call today. I greatly appreciate it. As Bill mentioned, I met Bill and Lisa at a crowdfunding conference where I was talking about investing in real estate through crowdfunding, and they were sharing some information about self-directed IRA investing and sort of where the parallels are between crowdfunding and self-directed IRA investing. So I'm excited to be on the call today. If you have any questions, feel free to stop me, put questions in the chat box, raise your hand, do anything on the GoToWebinar interface, and I'm more than happy to stop and take questions. Quick disclaimer on my end, I'm not an attorney or a CPA. I'm just a tried and true real estate investor. I'm a real estate investor, a certified wealth strategist, a securities holder, and a business owner myself. I run and operate Realty Mogul at www.realtymogul.com, and we are one of the largest real estate crowdfunding websites in the country. We started working in the crowdfunding business about 1.5 years ago now, have seen some great success, and are excited to be working with a couple thousand investors across the country now. And I'm going to talk today a little bit about crowdfunding and more specifically about how to generate cash flow from crowdfunding for real estate through your self-directed IRA. Now, I grew up in a family of cash flow investors, so I've always been sort of conditioned to be a cash flow investor. And what that means personally is that I don't invest in any ground-up development. I really look for investments that are generating income and generating cash flow. And I found real estate to be a really, really good way to do that. But before I go into that too much farther, I want to discuss just at a very, very high level what crowdfunding means. And at its core, crowdfunding means pooling money together from a group of investors to make an investment. In this sense, crowdfunding has existed in real estate for centuries. If you think back to neighbors who have bought property together, even husbands and wives or sisters and brothers who have collectively brought property together, and multiple institutions that have brought property and purchased property collectively. And in the past, this used to be called syndication. So syndication of the past is really crowdfunding of the future. And I want to share some of the differences between collective real estate investing of the past and crowdfunding for real estate today. The first one is the ability to transact online. Historically, these investments weren't being made online, and we've moved the entire investment process online, allowing investors to do due diligence online, fund online, sign legal documentation online, and have a transaction history and a record of all their investments. So that's one of the big changes. The second change is unparalleled access to deal flow. Companies like ours at Realty Mogul spend hundreds of hours scouring the marketplace to try and find transactions that we think are interesting from a real estate perspective. And while there's always risk in every transaction, it's a little bit different than the way it was done historically, where an individual investor would have to go find their own deal flow. That's one of the big benefits of crowdfunding, is that now that you've got access to the internet, you can access that from anywhere that you are, whether you're in your living room, you're in the office, and you have access to that deal flow that historically you didn't have access to. Another advantage is lower minimum investments. A lot of times with larger real estate syndicates, you'd have to invest $50,000 or $100,000, or even with institutional investments, it might be $50 million or $100 million. And we've modified that with the use of technology to allow investors to invest $5,000 or $10,000. Another advantage. Number 4 and number 5 are 24/7 access to reporting and money management and more transparency. So, the fact that it's online gives you 24/7 access. You have a secure login, a secure ID to see how your money is working for you. And more transparency is a result of having more eyes on the transaction. So, as I mentioned, we've got a few thousand investors who are investing with us at realtymogul.com, and they all add to the diligence process. So they're all doing diligence on the property. They're all asking questions. They're all clarifying points of information. And that's a greater level of transparency than I think you've seen in real estate historically. Real estate's been a very fragmented, highly illiquid marketplace, and I'm a big proponent and a big fan of transparency, and I think it's one of the things that crowdfunding brings to the marketplace, whether it's, our company or other crowdfunding companies. In the real estate vertical or in any real estate or in any vertical, whether you're investing in small businesses or startups or, any of the things that have come out with this new crowdfunding legislation. So before I go any further, I want to talk about passive cash flow. And you're seeing an image on the screen here, I hope, of a group of tenants and the frustration of dealing with tenants. The next image is going to show you, it's coming up here, I hope. I'm a little trigger happy with my clicker, so maybe skipping forward here, see if I can get it. Come on. All right, well, the next set of images should be a horrible image of a guy dealing with toilets, and then another image of a guy dealing with trash. Looks like I skipped it right ahead to the trash. But my point here is that when you choose to be an investor in any business, and in real estate specifically, you're choosing to be a passive investor or an active investor. And dealing with tenants, toilets, and trash is being an active investor. So dealing with the day-to-day management of that investment opportunity. And at Realty Mogul, we strive to only be passive investors and to only allow our investors, or rather give our investors access to passive investments and passive transactions. So at its core, earning passive income means you have separated how much money you make from your time. And this approach is very different than active income, such as showing up for work each day, where your time and income are linked. As a passive investor, you can literally make money while you sleep. You can have a steady stream of payments coming into your bank account automatically every month with little to no effort. And the majority of your time is spent up front, conducting due diligence on the investment opportunities and making the decision to invest after understanding the risks. So here's a screenshot of a bank account. And a bank account, as I mentioned, is one way to generate passive income, but earning 0.0001% or less than 1% on your money right now isn't really making you a whole lot of money and isn't generating you the kind of income that you want to generate as an investor. But at least we're getting closer. We've got cash flow without a second job, and even better, we've got cash flow day or night, whether you're asleep or awake and whether you're working or not working. But it still is not a lot, and that's where real estate comes in. Real estate has proven to be one of the most effective vehicles for reoccurring passive cash flow. Cash flow is normally generated when you get income from rent, sell a property that went up in value, or loan out money to a real estate company for interest. That's sort of enough of the basics. Let's talk about some strategy here. And I want to talk about two different types of real estate investments. And we're focusing on these two different types because neither requires you to pony up 100% of the funds to purchase a property, and they don't require active management. In the first type of investment, maybe you're investing in an office building, like an office building like this one. Or maybe you're investing in a multifamily apartment complex like the next slide. In either case, when you're investing as a passive investor and when you're using crowdfunding, you don't own 100% of the building. You just own a piece of the building. And on the next slide, you'll see an image of owning like the left-hand corner of a property. So maybe I only own that left-hand corner of the property. I benefit from ownership of the whole property, but I only own a portion of it. So what are the risks and benefits of owning a piece of the building? Now, I'm a fairly conservative investor. It's part of my rationale of being a cash flow investor, and I'm big on disclaimers. So let's start with the risks. The biggest risk to your cash flow is that expenses exceed income. For example, maybe the estimated vacancy is 10%, and at 10%, the building cash flow is great. If in reality the building experiences a 50% vacancy, that cash flow is going to take a deep hit. So that's your number one risk, is that expenses exceed income. The second risk is a decline in value. So you buy the property for $20 million, and when you go to sell the property, due to what's going on in the market, maybe it's only worth $15 million. That's another risk. You always want to be sure that you're buying at the right value. It's very, very hard to time market cycles, but it's easier to understand value in real estate. And you make money in real estate when you buy. That's a slogan you'll hear from a lot of real estate investors. You want to be buying at the right price. Now let's talk about some of the benefits. First off, you get to participate in cash flow from rents and appreciation when the property is sold. If you're buying a piece of a property that already has tenants, you might see your first check as early as 1 month or 1 quarter after you invest in that property. So there's cash flow that's being generated. There's also no management on your end. If a toilet breaks, you don't get the phone call. And you own a physical asset. It's not a stock that could have a lot of volatility or a bond that's going to fluctuate, but an actual building that you can see, touch, and feel. And this is sort of reoccurring passive cash flow. And if done right, it will be much more significant than any savings account. Now I want to talk about the second type of passive investment. And this is using your self-directed IRA to make a loan. I think many of you have seen some of the TV shows on A&E and TLC like Flip This House. But I don't want to talk about you becoming a flipper or you becoming a rehabber. That's a second job, and we're not looking for a second job. We're looking for passive income. So I want to talk about how you work with that flipper or professional real estate investor to generate passive cash flow. You do this by making loans and quite literally becoming the bank. Investing in loans secured by real estate is commonly called first trust deed investing in real estate circles. And it means that you, the investor, become a private money source and loan money to a borrower. Your investment in the loan is secured by a document called a trust deed. These trust deeds are filed at the county recorder's office, demonstrating legal proof that your loan has been made on the property and is secured by the actual property. By holding the trust deed, you're giving public notice to any other lenders or lien holders that you hold a debt on the property. You're also shielding yourself from the possibility the property is sold without repayment of the loan. Now that loan is said to be in first position because there's no other lenders that have claimed the property before you. Should something occur with the loan, you're in the best position to recover your investment. You also have title insurance to ensure that you really are in that first position. And one of the most important factors when making loans secured by real estate is to make sure that you have an equity cushion. At Realty Mogul, for example, we always look for an equity cushion in the transaction should something happen to the property or should the real estate markets take a dip. We typically look at loans that are less than 80% of purchase price, and this is called the loan-to-value ratio, or LTV. So you have an equity cushion baked into your investment. Now I want to talk about a couple of different reasons why we like investing in first trust deeds. The first reason is that there's lower volatility. Unlike the stock market, investing in loans secured by real estate tends to be less volatile. Now, there's always risk in every investment, whether it's a loan investment, a multifamily investment, or retail investment. But with first trust deeds and with cash flowing real estate, there tends to be less volatility. But primarily with loans, if a loan is paying 8%, you're going to expect to receive 8%, not 6% or 10%. It's also secured by the property. When you invest in paper assets like a stock or bond, there's no physical asset that you can see and touch. And when you invest in trust deeds, you know the exact property that you're secured by. Consistent cash flow is really important. At Realty Mogul, we provide distributions on our loans on a monthly basis. So every month, we allocate distributions to our investors on a pro rata basis based on how much of that loan they own. And there's diversification. Investing in trust deeds gives you exposure to real estate without dealing with the hassles of tenants, toilets, and trash. And with a lower minimum investment. So if our minimum investment is $5,000, you could take $25,000 in your self-directed IRA and invest in 5 different loans, giving you greater diversification than if you did this some other manner. So to recap, we talked about making 2 different types of investments. One is investing in a piece of a property, like a multifamily building, where your returns are a little bit more variable, but you get paid from cash flow and appreciation. And the other is investing in loans, where your returns are more consistent and your investment is secured by the property itself. Before we go back to talking about crowdfunding, I do want to provide one note about self-directed IRAs specifically and UBIT, which is unrelated business income tax. Again, I'm not a CPA or a tax professional, but there is something about crowdfunding in your IRA that is important for you to know, and we've done enough of these with our clients that we see some of these issues come up. So for transactions that use leverage, like in option number 1, like I was describing, investing in a commercial property, if there's bank debt or leverage, it may trigger unrelated business income tax. And this would require the IRA to pay that unrelated business income tax. Now, you're not necessarily paying that tax on the entire distributions, but there is a potential. So it's something that you definitely want to check with your CPA or with your accountant. On the other hand, UBIT should not be triggered when you're making loans secured by real estate out of your self-directed IRA. So on option number 2, like I described, it should not be triggered. And it also should not be triggered if there's no debt on the commercial property. So it's triggered with debt and typically not triggered if there's no leverage or no bank loan. Another interesting facet of using crowdfunding to get exposure to commercial real estate with your IRA is you cannot personally guarantee a loan out of your self-directed IRA. There's no personal guarantees that are coming out of these. So some of the questions that I'll get pretty frequently that I want to address up front is, how does crowdfunding really work and what do I actually own? Because crowdfunding is a new industry. It's been around for about a year and a half, and it's continuing to grow. So in our context, when you're investing with Realty Mogul and you're doing crowdfunding with Realty Mogul, you invest alongside a professional real estate investment company with a history and a track record. So we have what's called a curated marketplace. We don't allow any real estate professional to post transactions in our marketplace. As an example, we've underwritten over $400 million of real estate, and of that, we'll end up investing about $20 million of investment dollars. So it's a highly curated marketplace. And you're purchasing shares of a limited liability company as a limited member. So through your self-directed IRA will hold shares in an LLC. In turn, that LLC either owns a loan tied to a real property or a share of a specific investment property, like a retail strip mall or a multifamily unit. And there's some added benefits to an LLC. It gives you liability protection, which can shield your personal assets from the investment. So going on to the next slide, you're not making the decisions in an LLC. And from a passive perspective, ideally you don't want to. If you want to be a passive investor, you don't want to be bogged down with a decision every week or every month. So decisions in an LLC are governed by a document called an operating agreement. And they usually include a managing member and limited members. The managing member makes all of the day-to-day decisions, and the limited members act as passive investors on the transaction. The managing member in our case are the real estate companies that we partner with who have specific geographic expertise and specific property expertise with the transaction. And they determine everything from how much cash to distribute to when to sell the property. Now, there's always a business plan. So you've got some estimations of how long you're going to hold the asset, when you can expect distributions. On most of our investments, we look to make monthly or quarterly distributions, and you as an investor will know that up front. So from an operational standpoint, let me walk through how you get started to do crowdfunding for real estate. The first step is to create a new account. For us, that means going to www.realtymogul.com and creating a new account. The second step, after you have an account activated, is to start looking at new investments and browsing investment opportunities and selecting investment that you're interested in. So every investor has different likes and wants when they make investments, whether it's in real estate or any other type of investments. Some of our investors really like investing in retail. So they see an opportunity where there's a Walgreens or a CVS or a Starbucks or a Subway, and they want to invest in a retail shopping center where these big brands are located, or a Chase Bank or a Wells Fargo, for example. Other investors prefer single-family homes or office properties or multifamily properties. So as an investor, you get to self-select. You get to make that decision, and you get to do your own diligence. So the third step in the process is once you've selected the investment that you're interested in investing in, you finalize your investment by selecting your form of ownership. And this is where choosing self-directed IRA would come into play. So if you wanted to hold title to the investment through your self-directed IRA, you can select it within our system. And from there, we're going to work with your third-party administrator and your custodian in step number 4 to finalize your investment. So this is where we would bring in IRA innovations and say, we've got a client who's interested in making an investment. We have to have a third-party administrator involved, and that's where we'd go to them to finalize all the paperwork, make sure that the funding is done legally, and make sure that sort of all the T's are crossed and all the I's are audited for you as the investor specifically. The fifth step in the process, which is the most exciting step in the process, is sitting back and collecting payments. So you should expect to receive monthly or quarterly payments in addition to an update as an investor. So how is your investment performing? What's going on with the investment? We always provide updates. We want our investors to be in the know. Again, the caveat, there's always risk in every investment. Nothing is guaranteed. we're investing in real property throughout the United States, so there's always economic shifts, there's political shifts, but we do our best to know what we're getting into, and if there's any shifts in course or if the course is identical, to share those updates with investors. So with that, I'd love to open it up to any questions. My contact information is on the last slide here. Oh, one more slide, actually. This is a screenshot of what the, if we can just go back one slide. Great. This is a screenshot of what the dashboards look like. So what you can expect as an investor on Realty Mogul, if you do make an investment, how much money you've earned through your investments, and then also your diversification. I'm a big proponent of diversification in investing in general, and one of the things that I think is really neat about crowdfunding that we talked about is the ability to diversify across property types, across geographies, and across deal types. So I showed kind of door 1 and door 2, meaning equity investments and loan investments. So you can diversify across deal types. You can diversify across geographies. So maybe you're located in Texas, but you can make an investment in California, New York, New Jersey, and Texas. And that's something I think that you haven't been able to do a lot of, prior to crowdfunding, which is really interesting. And then my last slide is sort of the final reasons for passive real estate investing. Number 1, no toilets, no tenants, no trash. Number 2, you can leverage the smarts of other people. I'll share a specific example here. We closed recently on an investment in a multi-million-dollar apartment building in Texas. It was just outside of one of the major metropolitan areas in Texas. And the real estate company that we worked with, the principals have done billions of dollars of real estate, and collectively they own 11,000 units in that Texas market. And it's not an investment that we're still raising capital for. It's not an open investment opportunity, but I share it because a lot of our investors have never had the opportunity to invest with a company of that type of caliber before. And we're giving them that access. And, I can't sit up here and say that I have expertise in every single type of real estate and in every single market, because I don't. But what I do have is the network to leverage the smarts of other people, and the network to say, we're going to invest with the smartest multifamily investor in Texas, and we're going to invest with one of the best retail investors in Colorado, or whatever that market may be. That's really, really important. It's kind of coming to that realization that you can't do it all on your own. The third one is make money while you sleep. Especially when you're investing in commercial real estate or even single-family real estate, you've got a tenant in that property. So that renter is paying rent, irrespective if they're using it in the morning or in the evening, so you're generating that income. And the last one is do it seamlessly online from the comfort of your home or the comfort of your office. You have the ability to go in and invest, do due diligence, and make those decisions whenever it's convenient for you. So you're not limited by time zones or business hours anymore with the Internet. So that's realtymogul.com. Here's my contact information. I'm always happy to chat with investors, answer questions, or provide any guidance on any real estate investment that you're looking at, whether it's something that we're working on together or that we're working on externally. I try and pride myself on having a pretty good pulse on the industry and kind of what market rates are and market terms are. So if you ever have questions about that, don't hesitate to reach out. I'm an open book, and I'm always happy to share what I know and build my network and connect people. I find that it's something that I really, really enjoy. But, if you do want to email us, we're at info@realtymogul.com. You can also visit www.realtymogul.com. And I think, Bill, I'm happy to answer any questions if any questions have come in.
I'm going to unmute anybody, and if anybody's got any questions, just please speak up.
Julian, it's Lisa. I do have one question I'd like you to address to our listeners today, and that is, I know there's been some changes in crowdfunding. Have they impacted the accredited investor rules, and do your investors have to be accredited?
Yeah, definitely. So you're spot on that there have been some recent changes to crowdfunding, and those got formalized September 23rd, last Monday. And the changes are around generally advertising investment opportunities. And what that means is that, you may start seeing ads in the Wall Street Journal or the LA Times that advertise for investment opportunities in real estate and otherwise, small businesses, startups. Not all of those companies are necessarily
changing the rules.
self-directed IRA investing, so you'll want to double check with that. But they are still 100% limited to accredited investors. And we're limited as well to accredited investors. So thanks, Lisa, for bringing that up. An accredited investor is defined typically as an individual who has a net worth over $1 million or an income over $200,000 a year. There's a couple of other ways to qualify, but those are typically the most common, is it a net worth over $1 million or an income over $200,000 a year. There's some additional legislation around crowdfunding, which is still in sort of the proposed rule formatting, which will allow non-accredited investors. So it will reduce those income requirements and those net worth requirements. You know, those rules were supposed to be put in effect in January of this year, 2013, and we haven't seen anything out of the Securities and Exchange Commission or the SEC yet, but my hunch is that we'll see something about that in 2014 on those regulatory changes.
Anybody else? Okay. Well, I appreciate everybody joining in and coming in and
Hello,
talking.
I'm sorry, I had a question.
Go ahead.
Sorry about that. I feel muted on my own phone here. Lisa, what states are you currently operating in? Are you only in like 5 states right now, or are you in the whole country?
Jillian?
For Julian.
Jillian.
Oh, Jillian. Sorry, Jillian.
Yes.
Oh, got it. So we have investors all over the country. We have investors in every state in the country, I think. I'd have to double back on our database, but I think we were like 48 or 50 last time I checked. So my hypothesis is we've got investors in every state in the country. And we've got properties, I think, in 7 states right now. We're always adding new properties, but we've made investments in California, Washington, Texas, Kansas, Missouri, and we're adding new properties, you know, as we see properties that we like. We want to be in every state where we think it makes sense to be investing in real estate. That doesn't necessarily mean everywhere around the country. So there are certain states that we are feeder states for us, and other states that we've kind of stayed away from because we don't like the fundamentals in the real estate market.
And so, follow-up question. So there are, everybody always has competitors. And so essentially, I mean, do you see like a point where this market could get oversaturated with crowdfunding type sources such as yours, or is it kind of a wide open field right now?
You know, there's always the potential. You know, I think that the most important things for us are investor protection and growing conservatively. Our growth plans are pretty conservative because we want to make sure that we're staying within our guidelines and that we're only doing real estate deals when we should be doing real estate deals. A lot of that rests on the brand. You know, there's a handful of companies that have come in to do crowdfunding. My hesitation would be, as an investor, the biggest issue is make sure that the company that you're working with is well capitalized. It's expensive to run a business, and any of you who are business owners yourselves understand that. You know, meeting payroll is an expensive proposition. Our business, for example, we raised over $1 million in operating capital when we first started. We've got a variety of angel investors and also institutional investors who are backing the company. But I think it's a very big market. I mean, if you look at the size of the real estate industry, it's an $11 trillion industry. If you look at the size of private real estate investments, you're looking at a couple $100 billion. So it's a very, very big industry. I would just be careful about the types of companies that you work with, because you want to make sure that they've got your best interest at heart. You also want to be sure that they've got the capital for these investments. So, some of the investments that we go into are, 5-year to 7-year terms. There needs to be contingency plans in place. Number one, we need to be well capitalized, but number two, there needs to be contingency plans in place. So, whether you're investing in crowdfunding in real estate or in startups or small businesses, make sure that you do your diligence around that and get really, really comfortable with the company that you're working with. Whether it's mine or any other company, start skeptical. And as a CEO of a crowdfunding company, I don't know that you get that advice from a lot of other CEOs, but as an investor, you should start from a skeptical perspective. Make sure that your answers get answered. Make sure that you can get someone on the phone, and really get comfortable around it, because there are risks. There's always risks. There's always going to be risk. But I think it's a really big market. I think that you're going to see a lot of people that are doing similar things. And at the end of the day, you're going to have to decide on the strategy that's right for you and the company to go with. As I shared earlier in the presentation, we don't do any ground-up development. As a business, we've decided that that's too risky for us, and we're a little bit more risk-averse from that. So we do only cash-flowing real estate or only cash-flowing debt. Only either performing debt or performing cash-flowing real estate. We don't do any non-performing debt, and we don't do any ground-up construction. That being said, there may be an investor on the call today who really loves development and wants to access development through the self-directed IRA, which may be possible. but you just want to, clarify your own investment goals and then find a company that, you really trust and that you like their values and you like the way that they operate their business.
Very awesome. I think I should have been born with skeptical as my first name. But the one last thing, so if I was choosing between going through my standard old financial advisor for for REITs, for real estate investment trusts, and a platform like yours, what would be the big difference between the two for somebody like myself?
So let's talk, for a minute kind of about the pros and cons. I mean, one of the greatest pros about REITs or real estate investment trusts are that, a lot of them are publicly traded. There's actually publicly traded and privately traded, but a lot of them are publicly traded, which means you have liquidity. So you have the ability to buy and sell at will, and that's a major benefit. You do not have that with crowdfunding. Our investments are private placements into physical real estate. We can't liquidate them very easily. There's a restriction out of the SEC as well that you can't sell your interest for the first year. So for at least the first 365 days, there's no liquidity. So you want to keep that in mind whenever you make a decision. For those of you investing out of a self-directed IRA, liquidity is typically less of an issue because you're stocking away, capital and doing capital appreciation in your self-directed IRA for retirement. So ideally, you've got, some timeline before you want to liquidate that asset. So they tend to work really well in self-directed IRAs. The other thing that I'll share is how institutions do it. So MIT recently came out with a study, and I'm happy to share it if, Bill gives me your email address, or I can route it through Bill as well if you want to go through Bill. But MIT recently did a study which was on how institutional investors invest in real estate. And a typical allocation, like we'll take the Yale Endowment Fund, for example. David Swenson, who runs the Yale Endowment Fund, came out and said 20% of, an individual's portfolio or an endowment's portfolio should be invested in real estate. So out of 100% pie, 20% of that should go into real estate. And then MIT came out with this study which looked at institutional investors. Of that 20% pie, 5% of that is invested in REITs, and the other 95% is invested in direct participations in real estate. What that leads you to believe is that the returns are better. Now, I don't know if the returns are better or not because, I don't want to say something that's not true because we don't have enough history on our returns yet to compare them against the REIT cycles over the same timeline, which is how you'd want to compare it to do an apples-to-apples comparison. But, the institutions have been doing this for decades, where they've taken 95% of their asset allocation and put it towards private placements and direct investments in real estate. And the institutions tend to be smarter than a retail investor because they have tons of money being funneled into research and economic statistics, in addition to the teams that run these endowments and run these funds. So, from my perspective, there's a lot of benefits about private investing. One of them should be higher returns, and part of that is a liquidity premium. You're getting paid for that illiquidity. But another piece of it is the ability to get access to transactions that REITs can't access. So REITs are sometimes such large entities that they can't make a $10 million investment or a $20 million investment. They have to look at, $100 million properties, and there's some arbitrage there. So anytime that you can find arbitrage in any industry, be it real estate or otherwise, there's an opportunity. And I think that's one of the things that private real estate investments allows for is to work in investments that are outside of the purview or outside of the scope of a REIT that have the potential to drive higher returns. Now, depending on the specific asset, it may be riskier, it may be less risky. But those are just some of my thoughts on comparing, REITs and direct investments. If there's anything else, I'm happy to address it. But those are kind of my high-level thoughts on it.
Thank you.
Anybody else? Okay, great. Well, Jillian, I appreciate you joining us today and the information that you passed on to us on what you do and the opportunities in these types of investments and using self-directed IRAs to do that. I appreciate everybody joining us this afternoon, taking their time to dial in and listen to some of the things we've got to say. And if you've got any questions, you know how to contact me and you know how to get in touch with Jillian. So I appreciate everybody being here, and we're like right at 2 o'clock, so this is a good time to stop it. Thank you all very much.
Thank you.
Thank you.